As of February 1st, 2026, the silver market is still in shock. What many investors are now calling a Black Friday-style crash hit silver hard on January 30th, and the speed of the move caught almost everyone off guard. In just one trading session, silver dropped more than 25%. That's not a normal pullback. That's not routine volatility. That's a violent reset. But before panic takes over, we need to slow this down, strip away the noise, and talk about what actually happened, especially here in Australia and at the Perth Mint, because the reality is far more nuanced than the headlines suggest. What actually crashed? Let's start with the numbers. Yes, the minus 25.5% figure being circulated is largely accurate for Friday's single-day move. Earlier in the week, silver pushed above $121 per ounce, which translated to roughly 185 Australian dollars. That move capped off a month where silver had surged more than 60%. Momentum was extreme, sentiment was euphoric, and positioning was crowded. Then came Friday. Prices collapsed to around 98 US dollars, or approximately 141 Australian dollars per ounce. That is a brutal reversal by any standard. As of now, local Australian pricing is hovering between $140 to $145 per ounce. That's a huge drop from the peak. But here's the key detail many people are missing. Silver is still up more than 200% year over year. This wasn't a return to normal. It was a reset from extreme conditions. Why did panic hit the Perth Mint? Now let us address what everyone but us really talking about, the so-called Perth Mint panic. Despite rumors flying online, this is not about the Perth Mint going bankrupt. It's not about insolvency. And it's not about silver disappearing overnight. What happened was a liquidity and demand shock. Earlier in the week, before the crash, the Perth Mint and other major refiners reportedly halted new orders, not because demand collapsed, but because demand was too strong. Physical buying surged so aggressively that production capacity simply couldn't keep up. Bars, coins, allocated products, all moving faster than they could be replaced. That kind of environment puts enormous stress on any mint, especially when prices are moving vertically. Then the market turned. And that's where the panic narrative took over, the real trigger, the whoosh factor. So what actually caused the crash? The spark came from the United States. News broke that Kevin Warsh was being nominated as the next Federal Reserve Chair. Markets immediately interpreted this as a signal for a stronger US dollar and higher interest rates. And for precious metals, that combination is pure kryptonite. A stronger dollar makes silver more expensive globally. Higher rates increase the opportunity cost of holding non-yielding assets. The reaction was swift, and it was global. Forced liquidations made it worse, but the price drop alone doesn't explain the speed or severity that came from forced selling. Many retail investors, especially those who chased prices above $110, were holding positions on margin, borrowed money, leverage, thin cushions. As prices started to fall, margin calls hit, fast. And when margin calls hit, investors don't get to wait it out. They are forced to sell immediately, at whatever price the market will give them. That created a cascade. Selling triggered more selling. Stops were hit. Liquidations snowballed. This wasn't long-term holders exiting calmly. This was short-term speculation being flushed out. And once that process starts, it feeds on itself. Context matters. Here's what's critical to understand. The panic is not evenly distributed. If you bought silver 6 months ago, or even last year, you are still likely sitting on substantial gains. The stress, the fear, the emotional damage, it's concentrated among those who bought near the top, using leverage, chasing momentum. That distinction matters, because it tells us something important about where we are in the cycle. This wasn't a collapse driven by collapsing fundamentals. It was a correction driven by positioning, leverage, and sentiment. And that brings us to the big question, is this the end of the silver bull market? Or just the market reminding everyone that gravity still exists? So now we get to the question everyone is asking. Is this crash the end of the silver bull market? Or is it something very different? Most analysts, including those closest to the physical market, see this move not as a collapse, but as a technical correction. And that distinction matters more than you might think. Why this doesn't look like a bear market? First, let's talk about industrial demand, because this is the foundation under silver, and it hasn't cracked. Silver demand from solar panels, electric vehicles, AI data centers, and advanced electronics is still running at record levels. None of that demand disappeared on January 30th. Solar installations didn't stop. EV production didn't pause. AI infrastructure spending didn't vanish overnight. Those trends are structural, not speculative. Next, there's the supply side. And this is where a single day of price action doesn't change the reality. China's export controls on silver are still in place. That policy didn't reverse with the crash. Physical silver availability remains tight, especially in Asia. A paper market flush doesn't magically create new metal. It just changes who holds the contracts. The difference between price and reality. This is where many investors get confused, because price feels like reality, but in commodities, especially silver, price and availability can diverge. During the rally, mints were overwhelmed by demand. During the crash, that demand didn't disappear, it just became cautious. Physical holders didn't suddenly rush to dump metal. They simply stopped buying at extreme prices. That's not panic, that's rational behavior. The real panic happened elsewhere. It happened among leveraged traders, short-term speculators, momentum chasers. The people who bought silver as a trade, not as a hedge or asset. Why the panic feels bigger than it is here. That's another truth that rarely gets said out loud. Markets don't hurt everyone equally. If you bought silver at 40, at 50, even at 60, this crash feels dramatic, but not devastating. If you bought at 115 using margin, expecting 150 next week, that's a very different experience. So the fear you're seeing online isn't universal. It's concentrated. And that matters when we're trying to understand what comes next. What this reset actually did, this move did three things. First, it cleared leverage. The excess speculation that built up during a 60% monthly rally has been flushed. That's painful. But it's also necessary for markets to function. Second, it reset sentiment. We went from euphoria to fear in a matter of days. Historically, that's not how long-term tops form. It's how unstable rallies cool off. Third, it forced investors to rethink why they own silver. Was it a trade, a hedge, a store of value, or just a bet on momentum? That self-reflection often marks transition points, not endings. The Perth Mint context, revisited. Let's bring this back to Australia for a moment, because the Perth Mint situation tells us something important. The halt in orders earlier in the week wasn't caused by collapsing demand. It was caused by too much demand at extreme prices. After the crash, demand didn't vanish, it normalized. And normalization is not failure, it's stabilization. The mint didn't break. The system absorbed a shock. That's not what collapse looks like. So, what should you take away from this? Here's the grounded reality. Silver experienced a violent correction after an extraordinary run. That correction was amplified by leverage, margin calls, and macro headlines. But the structural drivers, industrial demand, supply constraints, and long-term monetary uncertainty are still in place. If you're a short-term trader, this move was brutal. If you're a long-term holder, this move was a reminder that silver is volatile, a reminder that parabolic moves don't last forever, and a reminder that timing matters. Final thought. Markets don't move in straight lines. They surge, they reset, they test conviction. What matters most isn't what happened on January 30th. It's why you're holding silver in the first place. If your thesis hasn't changed, if the fundamentals still make sense to you, then a correction doesn't invalidate the story. It just rewrites the pacing. That's the real takeaway from this so-called Black Friday crash. Not fear, not hype, but perspective.